Hello and welcome to the Week in Markets. I'm Paul Durrans and I'm joined by Sam Elliott, Investment Analyst. Now, it's been a busy week for markets, lots of economic data to digest, and we've had corporate earnings as well. But I suppose the main event of the week is the US inflation report. Inflation's been trending a lot better in recent months. It's on a downward trajectory, and that's making markets getting excited about interest rate cuts. So, Sam, let's start there. Inflation report, what were the details?
Thanks, Paul. And I think that's interesting that you say that inflation has been trending downwards but has been positive. But actually this week we saw, for the print for June, we saw the first monthly negative print in headline CPI since May 2020. And if you think back to May 2020, that was obviously the onset of the pandemic when economies went into lockdown. So first time on a month-on-month basis that prices have actually been lower.
And I think, just coming in there of just thinking about inflation. So inflation is prices increasing, but the rate of price increasing has been slowing. This print is actually prices are declining. So a key difference there that I think worth highlighting. But it just in terms of building out on the details from the report.
Yeah, sure. So market focus tends to be on the core reading of inflation, so that strips out the most volatile measures, things such as food, such as energy.
Yep.
And that actually came in positive but below expectations as well. So we look at things like shelter, which is the main component of that index, that came in less than expected, so that's the housing component there. We also saw other services such as airfares, hotel bookings come in negative as well, and also goods prices led by vehicles, both new and used, were lower on the month as well.
And I suppose, the market got excited last month when inflation came in below expectations. This month, another reading of coming in below expectations. How did the market react this time?
Yeah, that's right. So I think it's really just fueled expectations for interest rates coming at the end of this year. So we saw bond yields come down across the US yield curve. That's positive from a return perspective for bonds within a portfolio.
Yeah.
We also saw on the back of that, actually smaller companies within the US outperform large companies. So that really bucks the trend of what we saw so far in 2024.
Yeah, so quite a big rotation. You saw some weakness in those US tech firms, the likes of Apple, Nvidia, that have been doing so well this year. So actually negative returns there, but a lot of positive returns outside of that, which is encouraging for investors that are globally invested across different asset classes as well. So on the whole, quite positive. And I suppose just finishing off on inflation, we also had the producer price inflation today. So this is prices that producers of goods, manufacturers are charging. What was the details coming through?
Yeah, so actually in slight contrast to what we saw in the inflation print earlier in the week, where the producer price inflation reading came in ahead of expectations, so slightly higher than what was expected. We know that that's often linked to goods. We've talked in the past few months around the goods cycle within inflation leading services. So services have been a bit slower to fall down, where goods came down quicker.
Yep.
Maybe this reading just suggests a bit more volatility within that, maybe suggesting that goods prices could increase in the coming months.
Yeah, and so I suppose that would feed into the broader inflation basket where looking at the numbers on this week's print, goods inflation has been pulling down on inflation, but on this producer prices inflation reading suggests that it might actually start to creep up and less of a drag.
Which I think just highlights the importance of that shelter component, bringing inflation down further if the goods, which has been deflationary, may turn the opposite way.
Exactly. Excellent. So now we'll just move on to corporate earnings. So you've got the US companies reporting their results for the Q2. Quite a lot of focus is on corporate earnings, not on just what they're reporting in terms of their revenues and earnings, but also what management teams are saying. So we had a couple of consumer-focused companies report and some of the major banks in the US today. Starting with the consumer, any key themes coming through there?
Yeah, it's interesting just to see comments from different consumer-facing companies in different parts of the economy. So we look at things like Pepsi, obviously related to food and drink.
Yeah.
Also Delta on the airline front, so two very different parts of the economy, but really making very similar comments. So talking around the price increases which they've been able to put through over the last couple of years, maybe coming to an end. Delta were talking around how it's really been a race to the bottom in terms of reducing those prices of domestic flights within the US. Pepsi making similar comments around prices which have increased now, being have to reset to a lower level, just because consumers less willing to pay those higher prices now than they were coming out of the pandemic.
Yeah, coming out of COVID, they wanted to buy goods, they want to go on holiday. They've done that for the past few years. Now they're saying no more price increases and tapping out. And I suppose just on the banks front, we've had two of the largest banks in the world, but also in the US. Anything coming out there?
Yeah, a bit of a contrast really. So we saw JP Morgan announce record quarterly profits. Part of that was coming through was strength within their investment banking business, which outperformed what was expected. They also have a stake within Visa, so credit card transactions was supportive there as well. In contrast, Wells Fargo seen some pressure coming within their net interest income. So that's the difference between interest which they pay out on deposits relative to interest which they gain on loans which they've given out. So that's maybe just suggesting that demand for loans is slowing and also more competitive in terms of rates that consumers can get from different banks.
Yeah, so consumers shopping around really looking for the highest interest rate on their savings, and Wells Fargo having to prop up their interest rate to keep their savers. Okay, let's just finish on the UK. So we've had the general election last week. This week, back onto the economic data front with UK GDP. I suppose the second half of last year we had a technical recession. Coming into this year we had a bit of a rebound. Has that continued?
It has, yeah. So actually in April we saw no growth at all, so GDP growth was 0. Yeah. But coming into May, which is the print we had this week, GDP growth came in at plus 0.4%, which was ahead of what was expected. And just to have a look at what was driving that, we see services continues to be strong. That makes up the majority of the UK economy. But maybe what was different to previous months was actually some strength coming through in construction, which has been a negative contributor for most of 2024, but actually came in positive in May.
And I suppose what was quite interesting is that the UK economy is now accelerating or growing, but we haven't had any change in interest rates. So interest rates remain at 5.25%. I suppose why is the UK consumer, the economy still doing or recovering and growing despite interest rates being high?
Yes, so it's really the strength of the consumer, and that's linked to wage growth. So we see wage growth sticky at around the 6% level, and that's really in line with what we see from services inflation. So those two very much interlinked.
Yeah.
And that's a comment which came through from the Bank of England's chief economist, Hugh Pill, earlier in the week as well, where he was talking around getting closer to being comfortable to cut interest rates, but maybe just needing interest rates to stay at a high level for a little bit longer, just to counteract some of those more persistent parts of the measures.
Excellent. And we've got the next Bank of England meeting on the 1st of August, so we'll get an update then. So if you like the content, and then please subscribe and like. Thank you very much, and we'll see you next week.